What if I told you the biggest companies in America are making less cash than they're spending? Google just reported its first negative free cash flow since becoming a public company, and Amazon's free cash flow has collapsed as both pour hundreds of billions into AI infrastructure. Here's why that matters. If you own the S&P 500 or QQQ, these companies are some of your largest holdings, meaning your portfolio is heavily tied to businesses spending massive amounts of cash today for potential future growth. That's where an ETF called VFLO stands out. Instead of buying companies simply because they're the biggest, VFLO screens for businesses with strong current and expected free cash flow, focusing on companies that are actually generating cash while still growing. Since launching in 2023, it has outperformed the S&P 500 while also experiencing smaller drawdowns during market sell-offs. Of course, it's more concentrated with around 50 holdings, so it's not perfect and may underperform if mega-cap tech rebounds strongly. But if you're looking beyond market cap weighting and want exposure to financially disciplined companies, VFLO is definitely worth researching. Remember, this isn't financial advice. Always do your own research before investing. The biggest companies aren't always the best investments. Sometimes, the companies generating the most real cash quietly win.